And welcome to The Real Money Show. The number to start investing is 1-877-8-SILVER. Head to therealmoneyshow.com or guildhallwealth.com as well. And while you're there, click on the e-store to start investing. So, Darren, give us a quick update. Where's silver and gold sitting?
Well, John, it's been a bit up and down week. We've saw the front end of the week. We came in with a nice price. We had just been off of the bottom of a market, and we looked to be forging a move forward in both silver and gold. Silver ventured all the way up over $17 an ounce, and gold way up over $12.20 an ounce. And both metals kind of gave up a little bit of that ground. And as we tape the show here on Thursday, silver is sitting right now just below $16 an ounce in the $15.85 range. Well, gold is sitting just below $1,200 at the $11.94 range.
Interestingly enough, Darren, that in Canadian dollars, gold's actually up on the year, especially, and in rubles, it's really up on the year. Only in U.S. dollars does it actually look as though it's down.
Well, we're going to be talking with David Morgan on this show this week, and we're excited to have him, but this is one of the topics we're going to discuss. And on the year, gold's actually held its own. It's been a steady asset. It's actually just right around the range that it started the year at. And given the climate and the expectations and the sentiment changes and where silver's gone, silver remains our number one buy because it is totally undervalued. So we're going to get to David Morgan. We're going to hear what we're going to see for the 2015-16 year.
In the meantime, the number to start investing as we get started here, 1-877-8-SILVER. Make sure you go to The Real Money Show or guildhallwealth.com. While you're there, click on the e-store. And I want to remind you that the promotion is still currently active. For every 100-ounce bar of silver you purchase, you receive a 1 silver maple leaf.
What a great deal, don't you think?
Pretty happening.
We've been so busy on this week. It's been incredible. There's been so many people going to the e-store and purchasing 100-ounce bars of silver just to get the maple leaf, and it's a great, great deal.
And we're very excited to have the pleasure of speaking with David Morgan today. David Morgan is a widely recognized analyst in the precious metals industry and consults for hedge funds and high net worth investors, mining companies, depositories, and bullion dealers. He's a publisher of the Morgan Report on precious metals, author of Get the Skinny on Silver Investing, and featured speaker at investment conferences all over North America, Europe, and Asia alike.
Well, it's been a challenging year for precious metals this year, but a real buying opportunity nonetheless in the last couple of months. Silver broke out of its 5-month downtrend last week, but as with gold, the move was unfortunately not confirmed by action in the stock market. What is your current position on silver and gold prices, David, at this point in time?
Well, my current position is we've probably bottomed. I want to be cautious here. I've done a little better picking the tops on the way up than I have the bottoms on the way down, but nonetheless, we had a spike low recently where we actually got into the 14s in the aftermarket of the overseas market, and silver rallied substantially from there on very big volume. Key reversal, and those are called key for a reason. So from all the data that we can see and, being in this market for so many years, et cetera, I really think the bottom is in. Having said that, I did forecast the rally that we had recently, which is off that spike low. And then when I said we'd probably get into the 17th level and wallow around that level for a while, and the most likely scenario was to fall back off of that level. In the last few years, we've seen the metals trade into the last trading day of the year, establishing like the lows for the year. And that is probably a likely scenario here. I doubt we're going to see new lows in silver, possibly in gold. Gold started the year at around 1,200. We're roughly at 1,200 now. So although it's certainly gone up and down year over year, and the way you get that reported in the mainstream press is going to show that, gold is up a few percent or down a few percent if it remains near this level by the last trading session. Silver, on the other hand, is down significantly from the level that it started the year at, which is around 20. So, gold is obviously holding up better than silver on a year-over-year basis. As far as the overall equity market is concerned, the internals are extremely weak. And what I mean by internals is you have increasing prices on decreasing volume. That is something that's not sustainable. And anyone that does even a cursory view of technical work knows that when you have that kind of underlying weakness in the market, that it isn't going to be too much longer before you will see that weakness show up in the price structure. So I'm a little bit negative, or fairly negative, on the overall equity market, and I'm neutral to strong to bullish on the metals market. It's taken longer than I forecast, quite honestly. I thought after the big spike from the $19 level all the way up to 48, I was lucky to catch the top and tell people from the about 30 something level on up, please be careful buying at these prices, because there's going to be this is parabolic. It's going to end. It's probably going to end soon, and make sure that you buy some, maybe, but not all, et cetera. So I was trying to give the warning, even in the public domain, that things were getting a bit frothy in the silver market. However, having said that, I have to be finish the story, and I really thought, once the decline started, that the $26 level was probably going to hold, and it did for a very long time, and then it broke through that on very obvious manipulation. I mean, if you go and look at what happened at those price levels, $15.50 for gold and $26 for silver, the amount of paper sales was so astronomical relative to what the physical positions are. It was ridiculous, and yet certainly had a very large effect on price. And I think that was a psychological move as well, because once we broke that level to the downside in both gold and silver, a lot of people that had been bullish up to that point decided that things were not, right with the metals, regardless of what the fundamentals said, and they moved on to other asset classes, the stock market being primarily the beneficiary.
More of our interview here in just a moment. If you want to start investing in the meantime, 1-877-8-SILVER. Go to realmoneyshow.com and guildhallwealth.com. Click on the e-store. You can do that to start investing as well. Currently, the promotion is, and take advantage of this, every 100-ounce bar of silver you purchase now, you'll receive one silver maple.
There is a lot to be said for what is happening behind the scenes versus what we see in the paper pricing. And recently, you've been discussing the fact that physical silver demand is up with record sales of Silver Eagles, Maple Leafs in 2014, and total silver industrial demand, as forecasted by the Silver Institute, is expected to pick up as much as 27%, and that could add as much demand as about 140 plus million ounces of silver during and through up till 2018. What do you see in terms of the supply and demand picture for the next couple of years yourself?
Yes, great question, and really right to the heart of the matter. First of all, let's talk about demand in two frames. One is the retail investor market, and the other is the industrial side. And I'll break the retail demand down into the small collector, or small saver or silver stackers are referred to. And these people are relentless in their conviction about the silver market, and I applaud them. And I'm probably one of them, where I continue to purchase on a dollar cost average basis. I also do try to pick the lows from time to time, but I'm pretty cautious as far as, not spending everything saying, oh, this is absolutely it. I did buy at the recent spike low. I was not able to get in at that time, even though I tried. I actually was locked in about $16.25, which relative to the cost of producing silver is still, very undervalued. But back on points, the one thing about the investment demand side is that the small savers continue, obviously, by the amount of eagles and maples and the silver rounds, et cetera, sold. But the institutional side has been very, very quiet. You haven't seen any big purchases by the Physical Silver Trust from Sprott. You haven't seen Central Fund of Canada make any silver purchases in quite some time. And I'm kind of looking for that. You would think, the fundamentals, in my view, and many, haven't changed. In fact, they've actually improved, meaning that the overall global economy is certainly not doing that well, regardless of what the mainstream press says. So for people that have not participated in the precious metals as either a hedge or a way to benefit with appreciation of the asset are on the sidelines. And so there's a lot of potential new buyers that could come into the market, but the leaders of the market, so to speak, the institutional money really hasn't made a move here, even though the price levels are really very, very favorable to a longer-term investor. So I really like to see more participation, let's say, by at least one, if not more. And I think once one takes place, then you might see a follow-through by another one or two. But I am very clear about, the reasons why they may not be participating at these levels, and it isn't because the price isn't very tempting. It has to do with the structure of the asset class, where they need to have a premium on their asset in order to be able to float the prospectus and go through the procedures that's required in order to buy more. So in other words, if you don't have a premium in the physical asset trust, PSLV as an example, they're not able to go into the market and actually purchase. So the fund has been actually at a slight discount at times and a slight premium at times. It's kind of oscillated back and forth. So, that's something I'm looking for in 2015. I think it'll take place. I'm not sure which one or both or more, that type of thing. The other one that's a little tough to figure out is the GLD and the SLV. The GLD has, had a pretty big offtake, whereas the SLV has actually had, more silver come into it. So there's, a little bit of discrepancy there. Of course, then you can, build the argument the other direction and say, yes, David, but if you look at the Singapore exchange and the amount of silver inventory that was once there and what's left, it's been depleted, in a very, very significant way, which is true. I'm just trying to be factual here. What I'm really saying along about way, perhaps, is that the demand side for silver on the investment side is extremely difficult to figure out. I use the best studies in the world and, of course, my own analysis and my own connections. And so I'll state this. I think that the retail demand is strong, much stronger than the price would indicate. I think you can take that as fact, although it's my opinion, but it's a very studied opinion. And then I think on the institutional side, I think we're just going to have to wait. But I believe the demand is still there, and I think that you will see it come into the fore sometime during 2015. Now, going to the industrial demand, if you go back better than a decade, the demand side for silver was roughly 35% of the market. In the last several years, it's been about 50% of the market. So it's gone up even while silver production has gone up. But it's leveled off. It's been around the 500 million ounce round numbers for quite some time and leveled off. And it really hasn't varied that much. I mean, people make a big deal about, industrial demands falling off, but or increasing. We haven't seen a substantive increase other than the one I just outlined, where we went from I forget the exact numbers. I want to give the correct idea, but 350 million ounces on the industrial side up to 500 million or 550 million ounces on the industrial side. And there again, to repeat, leveled at that area for quite some time. Now we're looking at an increase of about roughly 25% basis this this paper put out by the Silver Institute that was prepared by this group, CRU, and that's available on the web. It's an independent authority, and they did a pretty good study on the silver market. It's pretty similar to the 10-year analysis I did back in 2010. And so this would be substantive on the demand side, and they cover, silver and batteries, ethylene oxide, automotive, brazing and solders, printed circuits. But primarily the driver, again, in all that is photovoltaics. And the study that I used for photovoltaics that showed that we would be using approximately 130 or 140 million ounces of silver on an annual basis in photovoltaics was fairly accurate for the first few years, from 2010 to, say, 2012 or so, but fell off. And it really wasn't because the demand for solar panels had fallen off. What had fallen off, or what has taken place, is that the amount of silver used per panel decreased substantially, which is pure economics. I mean, that's true of any business. You basically want to use as little of the product as possible, especially if it's a commodity that's, fairly high priced, and, make the end product very, very reliable, very, long life, and that type of thing. So what happened is that the increased demand on solar panels, the manufacturers began to look at them, and ways that they could improve, and they've improved them. And in the improvement, it uses less silver per panel. nonetheless, the thirst for solar seems to be, according to the study, robust, and I believe that's true. And so you're going to see a driver on the industrial side. And I think that a lot of the drivers on the industrial side are not that economic dependent. A lot of people say, well, David, that sounds great, but, we're, at the precipice of another, global downturn or whatever, and it certainly seems to be the case, and I agree with that. But a lot of these areas, photovoltaics in particular, printed circuits. I mean, the reason that this study shows what it does is that that silver is being used in these products because it's the best available and the most economic available. So in other words, if you want to save money in making these products, you're going to want to use silver in the application. So I'm very, not overly, bullish about it, but very bullish. I mean, I think it's realistic, in other words. I don't think it's overstating the case. It could be. I mean, you got to remember who you're talking to. I'm rather much, one of the bigger bulls in the silver market out there. But nonetheless, after having read the study like 3 times, I think that their projections are actually, I wouldn't say they're that conservative, but I don't think they overstate the case at all. I think it's rather significantly well thought and researched. So I think that this is a very good factor for the silver demand. But one thing I'd like to go on, and you didn't ask, is on the demand side is what I've been alluding to, and that's a downturn in the global economy. I mean, if you could take away 70% of the supply in any market, then obviously you've had a big supply disruption. And people fail to realize very studied silver bulls know this, but 70% of the silver market is a result of base metal mining. So if we have a very large global pullback, and it certainly looks like we will with, 70 million apartments built in China that are unoccupied. I mean, talk about a misallocation of capital. And China being the main driver for the commodities, generally speaking, not only the energy markets, but, aluminum and tin and lead, zinc, copper. With that demand subsiding in a rather significant way, you're going to see not only less demand, you're going to see less supply because the demand isn't there. And what that could indicate is that there'll be less silver coming to the surface as a result of base metal mining. If there's a big degradation in the amount of lead, zinc, and copper that's demanded on a global basis, then there'll be less silver coming to the surface. And again, that's 70% of the market. So you've got that factor, and you also have the fact that most primary silver producers, making up the other 25% of the market, are underwater. I mean, there's a few out there that can make money at $10 silver, but they can put those on one hand and there's a couple fingers left over. The rest of them were marginal around $20, but they're not able to sustain forever at these prices. So that, again, I'm not saying could curtail the market, even on the primary silver producers. So we have a situation where the price is dictating a lot, the global economy is dictating a lot, the industrial side is dictating a lot, and for all those reasons combined, I see it as a synergy. I see an industrial demand increase, I see an investment demand increase, I see the institutional side having demand that's pent up that hasn't been realized yet. And then, of course, with the unfolding of the global situation being what it is, there could be a run to gold. And with the run to gold, then what you would see is, little sister silver going along with it. And since it's a smaller market and there's a lot of people that wouldn't be able to afford gold once it really gets going, they would spill over in the silver market. So I'm still rather bullish on the metals.
And we'll take a short break. More of our interview with David Morgan on the way. In the meantime, you want to start investing, 1-877-8-SILVER. Go to guildhallwealth.com or therealmoneyshow.com. While you're on guildhallwealth.com, a reminder, click on the e-store, and for every 100-ounce bar of silver you purchase now, you will receive 1 silver maple. And back with more of our interview with David Morgan right here on The Real Money Show.
I think that it's a very valid point when you're discussing the extension, the demand side of the market. If there is a global slowdown coming, and we can expect that there's going to be some type of liquidity crunch similar to 2008, do you think sentiment is different this time around with investors? Do you think they have enough common sense to move into better assets like silver, let's say, or gold, for that matter, prior to this occurring? Or does the same thing happen again? We trail down, and then, of course, silver and gold end up being the fastest two assets to recover?
The honest answer is I don't know.
Right.
And I say that with a lot of conviction.
Sure.
I mean, if you go back to the 2008 crisis, and I was, right there and had a pretty big silver position, and, when it came down, I was not happy and also a bit surprised. I thought silver could probably go. There's always the excuse that silver is more of an industrial metal, and so if the stock market sells off hard, silver's going to go with it and all that. And I get all that, and there's some validity to that. But gold fell off as well. Obviously not as much as silver. It's a bigger market. But I was surprised. I thought that gold might, come down slightly or not move, or possibly go up against it, which is what, most of the academics will tell you, me included, that, in that kind of a sell-off in the stock market and uncertainty in the market and panic in the market, you would expect gold to, at least hold its value and or go higher. And that's not what happened. However, what did happen was that they recovered very, very quickly. But now you're asking, would it happen again? And I don't think it would. I mean, the answer I said, I'll repeat, I don't know. But the psychology of the market really has been beat up. I mean, silver's been in this bearish mode for like 4 years, and gold well over 3 now. And so the mood of the silver and gold bulls, I mean, a lot of them have given up. I know some personally have rather significant silver positions that basically threw in the towel at, 25 or 22 or under 20 even, and basically probably will never come back into the market. So we do need new buyers. The bulls that have conviction are holding. Certainly, they may be buying more, but they're waiting for various prices, and some of them may lighten up. I mean, if you're over committed to a market, and I stress that you shouldn't be. I really, as much as I like the metals for lots of reasons, it doesn't mean that that's the only asset class you should participate in. But regardless, people that are overcommitted may have, let's say, an average price of, let's just pick a number, 26. That's a big psychological number in my studied view. So we get up to, let's say, and they hold their position and say their average price is 26. So they get to 26, and, they got 50% of their net worth in silver. They might decide to lighten up at a break-even point, for example. So it's not going to be like 2008 coming back up, where it was so brief that most of the people just held, and as the price went up, they either bought more or held in a position. In this case, you've got a lot of what's called overhead resistance. So a lot of those people that are overcommitted or whatever will get to the point of break-even, wherever that is for them individually, and see, silver's back to 22. That's where I bought it. Thought it was so cheap, Morgan told me that was the cost of production for XYZ mining, and I have, if they get the report. They know some of the primary silver producers what they exactly, what their exact costs are with no fanfare and no BS, absolute truth. And so they bought it because of, our research, and they said, what, it's below that, now it's back to it, and I'm out. I don't want any more silver. I don't want anything to do with it. There's some of those people, and that's human nature. You can understand it. I understand it. I still think that everyone should have a position in the metals, and I firmly believe that, but that doesn't mean very many people agree with me. In fact, I got a 99% anti-Morgan contingency out there. Only 1% of the people out there actually believe in the metals and buy physical metal. So, it's a very, very small market. Nonetheless, that overhead resistance would caution me that you wouldn't see it similar. I think it'd have to ebb and flow and work its way up. But however, I must give a caveat to that statement. That's in normal market conditions.
Right.
We're in anything but normal market conditions. So as an example, if things were starting to get even more, I have to use the word bizarre, in the currency markets, and the reason I chose that word is it's meaningful, that with what's going on with the Russian ruble and being able to halt trading in some instances and going up to 17%, it reminds me, being old enough to know what Volcker did with the U.S. dollar, pushing interest rates over 20%.
Right.
So with all that happening, I can't rule out that there couldn't be a sudden run into gold or run into silver because of conditions that are, once in a lifetime or once every, 5 lifetimes type of scenario. And I won't rule that out. In fact, I actually think that the probability of that is actually quite high, much, much greater than a bell curve would normally show you. In other words, if you look at what's called the tail end of the curve, where you have a very low probability that's happening. You have to look at the conditions as they are, and the conditions as they are right now, the probability of some kind of an event are very, very high relative to what they are normally. So we're certainly in not normal conditions. So because of that, I can't say that this overhead supply, et cetera, would basically mitigate the market, because if there was a panic buy for whatever reason, the people that owned it would hold it, and they might even buy more. And then they might tell their friends or neighbors and everybody else, and all of a sudden there's a run on gold. And so I don't want to misrepresent it either way. I want to be as clear and concise and precise as I possibly can, because it's important for people to think these things through. One of my favorite quotes is, "Chance favors the prepared mind." You have to look at every scenario, and nobody can. I can't, Jim Rickards, any of these people that are pretty good thinkers in these markets. None of us have an exclusive, all-seeing, all-knowing probability. I mean, we have probabilities, I'll back up, but what we don't have is an all-knowing knowledge of what could take place. We have basic scenarios, and you know what? The scenario that takes place is probably one that's different than any of us have thought of. Looking back, why didn't I see that?
Right.
Why didn't I see that China would come in and tell Japan to do this, or drop the yen, not the dollar, but because the yen got dumped, it took the dollar down, or some other scenario, one I don't talk about often, and we could talk about them all day, and again, all of them could be incorrect, but the idea is correct, that we're in a situation now in a global financial empire that is so uncharted, unknown, and there's so many caveats to it that the authorities have taken. I mean, putting the U.S. citizenry on the back of the derivatives exposure. So we can bet, and if we're wrong, you pay for it. I mean, this is ridiculous, but this is what has taken place recently. So caution, caution, caution. If you're not in the metals, I think you should be. And again, the correct amount is an individual choice. I've always recommended 10% as a minimum. And I think in the current conditions, 20% really isn't excessive for most people. But beyond that, you can get overexposed, and then if the metals continue to trend down or sideways for a while, people get discouraged rather easily. I mean, there are people with long-term horizons and strong convictions, or others that just basically took a 10% position, some time ago. I mean, certainly my average price is pretty low, even though I've bought as high as 30 actually, but it wasn't a significant amount relatively to what we hold. But nonetheless, the average price, because I began so early, is rather low relative to what the price has been.
Right.
So I'll probably beat that one to death. But that's a great question, because it's important to know that the black swan and all that people kind of make light of, they do happen, and they could happen. And the way things are going right now, with what's going on with the Russian ruble, what's going on in the energy markets. By the way, let me just add something very important that's out on the net, and a lot of people don't know this. But what took down, or at least was pointed at historically for the takedown of the global financial crisis of 2008, was a subprime mortgage debt. And now the subprime oil debt is what I'll call it, which is all this fracking that's been going on, which is all in the junk bond market. So in other words, it's subsidized, similar to the way the mortgage market was subsidized, is underwater significantly. And that amount of debt is at least double what it is in the subprime market. So I want to be perfectly crystal clear and repeat myself here. The amount of derivatives exposure that caused the 2008 financial global crisis, that event, that's history. We're now in a position where we're weaker than ever. There's fewer banks than ever. And the global exposure in the derivative situation is twice as bad as it was there, and it's in a key element, as important or more important in my view than shelter for living, and that is the energy markets. So we're in very thin ice as far as I'm concerned. And this is something that people need to wake up and realize, because in my view, we could get to a situation where the run to gold is so strong, and a lot of these people that write on, what's considered the fringe. I don't consider it the fringe, but some people do. That, there's all this manipulation in the market, and where's the gold, and how many times it has been hypothecated and rehypothecated, and who really owns it, et cetera. The point I want to make is that you could get in a situation where the physical market starts to seize up, or does seize up, and maybe only for a day or two, or a week or two, or counterparties cannot be determined. There's a lot out there in this convoluted derivatives market, and if that were to occur, then there'd be a run to the secondary market. And the secondary market isn't necessarily the futures and options market, it's the mining shares.
Right.
So you would see, could see a run into gold and silver like you've never seen in the history of mankind, especially if the physical market was starting to have problems with physical offtake or derivatives exposure, or both at the same time. In other words, multiple claims on gold and silver that couldn't be determined, or had certain timelines on them that, you can't go back until, September 2016. That's what the contract says, and, on and on it goes. So it's a very, very deep rabbit hole, and it's one that I don't think any one analyst knows everything about. Certainly I've looked at as much as I possibly can. I've tried to separate the wheat from the chaff the whole time.
Sure.
But I can't give you an absolute, but I certainly have a good feeling for it. I'd say my feel for the market is probably as good as most, and I do it from both, from the bottom up. I do it from the retail investor standpoint all the way up, and a top-down analyst that I am. From the commodity only, what is silver? Why is silver important? Who would want silver? Why would they want silver, et cetera? So I look at it from both directions, and I think, again, that gives me a rather different view than you might get from a Wall Street analyst that looks at silver and basically has, a huge derivatives book and helps, major producers hedge their positions, which, I'm not against. I'm just saying that their viewpoint certainly might not be as broad as mine is.
And we'll take a short break. More of our interview with David Morgan on the way. In the meantime, you want to start investing, 1-877-8-SILVER. Go to guildhallwealth.com or therealmoneyshow.com. While you're on guildhallwealth.com, a reminder, click on the e-store, and for every 100-ounce bar of silver you purchase now, you will receive one silver maple. And back with more of our interview with David Morgan right here on The Real Money Show.
In terms of sentiment, if you look back at the 70s and what happened in the middle of the decade, I mean, I can imagine how many people kicked themselves in the rear end for having left behind the gold market only to see it flourish coming to the end of the decade. And, of course, it was dramatic. I mean, with the drop in pricing, most people probably walked away from it like the sentiment has more recently been in terms of the silver and gold market. But I mean, as far as moving forward, this is why, and we have said the same thing too, that 10 to 20% in your portfolio that you might have in gold or silver in physical form is so prudent. It's so smart, because you don't know what's going to happen, and God forbid another major event does happen and there is something like this subprime oil that does come to fruition. We're watching it closely, but if it does, it's going to be a horrid thing, and I don't want anybody to think that that's what we're going to relive. But I mean, it does put the emphasis on understanding the importance of having assets like gold and silver in the portfolio. So for 2015, David, before we let everybody know how to get in touch with you, what is the best case scenario for David Morgan in terms of what silver and gold might be doing?
Yes, I'm going to answer that backing up to what you said. I mean,
sure.
Go back to the last market, and you saw, gold, go from its fixed price all the way up to around 200 and fall off to 100. And it took quite some time to get back up to that 200 level. And again, using my analogy earlier, that there are people that bought probably at that top at 200-ish. And then when it finally worked its way back to that level, sold out because they were broke even and they were tired because they watched it, lost 50% of their investment value based in paper dollars. They saw it go from 200 to 100, round numbers, back up to 200, got out. But once it made that $200 or came back up to that level, it accelerated from there to 800. It did a fourfold increase in a rather small amount of time. Silver, on the other hand, did even better. It started in 1979 at $6, and then in January 1979 at $6, and in January 1980 it went up to 50. So you had like an 8-fold increase. So one thing that on my new book, The Silver Manifesto, that will be out early in 2015, and I wrote this book because I really believe that this is the time that the people that have been waiting on the sidelines or don't understand are starting to wake up. And I want everybody to. I mean, I feel for the, bulls out there that are underwater or upside down. I have empathy for that position. Nonetheless, I would encourage them, and hopefully they didn't overcommit, to just hold. regardless, my point being is that something that I actually got from Jeff Christian from CPM Group, stating that 90% of the move comes in the last 10% of the time. And I did the arithmetic on that, and I forget the exact numbers, but the idea is very, very sound. It was something like 88% of the market happened in the last 7% of the time. But the point is that once a thing accelerates, which is what we talked about earlier about a potential black swan, that people are running to gold and running to silver for whatever reason or reasons, that it's an acceleration phase. So you want to be in early. You don't want to be in that panic manic buying phase where maybe this time you can't even get it, or you can only get it in retail quantity size. You can't get it significantly as a hedge fund manager. For Sprott, for example, wanting to buy another 20 or 30 million ounces of physical silver can't be obtained. Now, I'm not stating that's the case. I just want to give the idea that once these panic buys start, that things change, and it can change rather rapidly. So where do I see 2015? I see 2015 as a moderately uptrending year, if everything holds together as it is, with no black swans involved. So I think we're going to work our way back. I would see, what I really want to see for a psychological perspective, price-wise as well as price points. I like to see gold above 15, 50, and 26 on silver to get over that breakdown point that was so significant and is held now for quite some time, where, again, I think the psychology of the market was beaten up enough to where a lot of people that wanted to buy decided to leave or to not participate in the market. And those that told themselves that they would buy low really haven't. Going back to my chance favors the prepared mind, if you were of the idea that, geez, you really want to hold out and buy when it got low, well, now's your opportunity. I am ringing the bell. I am stating so. Is this the exact bottom? I don't know. What I do know is if you can buy any commodity under the cost of production and have some patience, you're going to make money. And that's true of both gold and silver, particularly silver market right now. Should you own silver or gold? I think you should own both. I think the older you are and the more conservative you are, the more you should favor gold. And I think the younger, more aggressive, and the more risk tolerant that you are, the more you should favor silver. So I think I'll conclude with that.
If you're enjoying the interview with David Morgan this afternoon, we'll get to more of that in just a sec. I want to remind you to start investing. It's 1-877-8-SILVER. Go to guildhallwealth.com, click on the e-store. And right now, every 100-ounce bar of silver you purchase, you will receive one silver maple.
Well, David, it's been a pleasure. And again, you're very insightful, and we've taken your advice year and year and year, one after the other. And to have you spell out some of the pitfalls and to talk about what is your expectation for the coming months is awesome, and we do thank you for it. How can our listeners get in touch with you, David, and use some of your services?
Well, first thing I'd like to encourage everyone to do is to occasionally visit our website. It's not a static website. I do put up videos every week or so. There's one on there right now that's only going to be up for another couple of hours, and it's regarding a movie. And I've used these movie clips in the past to make a point, but it talks about the Russian ruble and what the Russians have done with their foreign currency exchange and basically sandbagging the U.S. dollar. Could be pertinent, could not. I'm not really forecasting. It has meaning. It has meaning from the aspect that causes people to think. So I'd encourage people just go to the website, silver-investor.com, and check it out probably on a weekly basis. If you want to follow all my work that's in the public domain, you can go to Silver Guru on YouTube. If you want to see everything I read that I think is important to not only the metals markets but the general economic conditions, then you can follow us at Silver Guru 22 on Twitter. That's put up there myself personally and a couple of our staff members, and that's all who has access to post on our Twitter account. But if you're really following these markets closely, you can see basically if I read 10 articles and these are the top 2 articles I think people should see, I send them on a Twitter feed. I'm not really interested in people knowing if I'm having a latte or not. That doesn't interest me at all. I don't use Twitter for that. Also, if you go to the webpage, silver-investor.com, if you're there the first time, you'll get a pop-up window that only bothers you once, and you can get on our free e-alert letter. I really think that that's important going forward because we do a weekly wrap-up, and we give out the interviews like this for everybody, and it's free. And we also give insights, and we take questions from all readers, not only our paid members. So those are all free, available. If you're serious about the metals market, we do leave our best thinking and our consultations and that type of thing in the Morgan Report itself. there's 3 levels of service, and that's described over on the right-hand side. And, if you really have questions or whatever, I mean, at this point in time with our business down rather significantly, occasionally, I'm not going to say I do this in every case, but occasionally I'll actually pick up the phone myself if I have the time and can, talk to people. I usually give them like 5 minutes or so. But we do consulting. I've consulted with people that I can't name that are rather significant in the industry, not only the silver mining side, which you could probably guess, but also significant on the institutional side. In fact, I'll just brag slightly, but there was a gentleman that visited Bill Gross some years ago before Bill left PIMCO that he started. And after visiting Bill, he called me and took a rather substantial silver position. And that always raised my eyebrows in a way because, the bond market is the keys of the kingdom. It's the debt markets that the big problem lies in. And I think anyone that knows anything about finance understands that. And this is where the problems are starting to show right now with this, I'll call it the beginning of a currency war with the Russian ruble. So interesting times. Again, I don't think 2015 is going to be that significant. I think it'll be higher. I think things will probably hold together. It's hard to know, but you'd rather be early than late, so I'll leave it at that.
Well, listen, David, we thank you very much for your time. I hope you have a wonderful holiday season with you and your family, and try to get some rest because I know you're thinking very hard about this market and answering a lot of questions for people. So thanks again for being a contributor here on the show, and we look forward to speaking with you in the new year.
Thank you. My pleasure.
All right. Take care.
And want to thank David Morgan for joining us this afternoon. Again, the number to start investing, 1-877-8-SILVER. Go to either therealmoneyshow.com or guildhallwealth.com. While you're at the second one, click on the e-store to start investing. And right now, by the way, take advantage of this. Every 100-ounce bar of silver you purchase, you'll receive 1 silver maple. We'll get into Colored Diamond Show next. Hang on. And back into the Real Money Show. The number is 1-877-8-SILVER. Go to therealmoneyshow.com or guildhallwealth.com. And while you're there, every 100-ounce bar of silver you purchase, you will receive 1 silver maple. So keep that in mind when you're investing into diamonds, guys. Jeremy, what's the story? What's new?
One of the things that's new is De Beers has put out an article basically discussing this concept of recycling diamonds. It's not new for myself. A few years back, I saw a seminar with Rappaport, and he was discussing that in North America, a lot of people they call it recycling diamonds, meaning a diamond's been in the family for a long time, and they pass it down, or they're reselling that diamond down the road. The reason they're bringing this up is because they're realizing that within the next few years, there's going to be disruptions in supply, that it's going to be tougher to supply the market, that mining is on a downtrend. So they're shifting gears. I guess a diamond isn't forever. It can be passed down or resold. And that makes us happy at Guildhall because that's something that we do. For anyone who purchases a diamond from Guildhall, we're more than happy to help them resell that diamond. We don't resell any other diamonds than what we have sold, because in our collection
there's a very good reason why we don't sell other people's diamonds, because we search out the best of quality in a diamond, and there are a lot of companies out there will settle for second best. When we buy a diamond, everything about a natural fancy colored diamond has to be correct. The color is the first thing that we look at. The color has to be evenly saturated on a natural fancy colored diamond. The next important thing is the cut, because if the cut has too many facets in it, or it's badly cut diamond, you're not going to get the fire and the scintillation that comes off of that stone. Thirdly, we look at the carat weight, which is important when we're buying stones, for the simple reason that in a natural fancy color, anything in a yellow, you need to go over a carat. Pinks are a lot different because they come in smaller sizes, normally 1/4 of a carat and up. And the other thing that we're looking at, I said the cut, the clarity is the other thing that is very important. So if you look at our website, go to guildhalldiamonds.com, you're going to see in yellow diamonds, the majority of the diamonds that we carry are internally flawless. That means there is no inclusions. There is the odd diamond which you'll see VS, and the only reason that I purchased those diamonds because of the VS in yellows was all about the color. and the color comes first. But when we go to Argyle Pinks, we only carry VS quality. We don't carry anything below that. So when it does come to reselling a diamond for our clients, every diamond that we've picked out is top drawer, top notch, cream of the cream, and it's very, very easy for us to resell that product because we know everything about that product.
Yeah, there's a strong focus on curating our diamond collection, and we back that by going out and actually purchasing that and owning it. There certainly are companies out there that will sell on behalf of a dealer or a distributor of diamonds, and you'll see a lot of companies that sell a plethora of diamonds, just a lot of different diamonds. Even in the colored diamond sphere, we go out and really try to sniper and find those really particularly good quality diamonds. One such diamond is something that we are talking about this week, which is a .25 fancy purplish pink. It's a brilliant cut diamond, and it's a VS1.
Plus, it's an Argyle diamond.
Right, and we're having always a tough time acquiring Argyles, always having a tough time acquiring Argyle diamonds in this sort of size range because they do not last long. This, again, is a fancy purplish pink, and there's definitely a premium on purplish pink diamonds from the Argyle mine. And again, this is a .25 brilliant cut. The price on that diamond is $35,000. But of course, we're including the taxes this month. So it's a great opportunity to get into the Argyle diamond market. This market is completely on fire, especially for residents of the United States. They are really, really snapping up the Argyle diamonds. But to get any of them in is always great. And again, these never last long. I don't want to sound like I'm on the shopping channel here, but they really don't. And oftentimes they actually don't even make it to the website because our clients will be purchasing these type of diamonds because they're just in that perfect range. So again, a .25 purplish pink diamond, which is a really nice jewel tone, and it's a brilliant shape. And again, it's starting at $35,000. No taxes are included. Yeah.
And the great thing is if you're looking for an investment, if you're putting your kids through university or you're looking to retire, a diamond like this that is going for $35,000 taxes in is going to appreciate at an unbelievable rate. Argyle pinks are actually doubling every 3 to 4 years. So a $35,000 diamond easily in 7 to 10 years is going to be worth over $100,000. Wow. And in 15 years, it's going to be a $150,000 diamond. The Argyle mine is closing probably between 2018 to 2020, which means that's the end of these diamonds. There will be no more on the market, and they are going to be holding or carrying a huge, huge premium. So this is an opportunity to get an Argyle pink, a .25, that's a quarter of a carat, fancy, purplishly pink, $35,000 tax in. This is an absolute steal. It's something that you should put away in a safe deposit box, put it away for your retirement, put it away for your kids' education. You will make nothing but money, and especially being around a brilliant cut. In Argyle pinks, that actually puts about 40% more on the cost of the diamond because you don't normally see rounds in Argyle pinks. They're normally emerald cut, cushion cut, but being a brilliant, there is an upside. It's a diamond that becomes very, very desirable. So this diamond is appraised at around about $70,000. It's $35,000. Taxes in for the month of December. This diamond is first come, first served.
Jeremy, say you don't want to leave it in a safety deposit box. It's so nice you want to put it on your finger.
Yeah, and you can do that with this. What we're seeing is a trend in jewelry to take a smaller diamond and put halos around it, right. Whether it's 1, 2, maybe even 3 halos, and it will really increase the appearance of the size of the diamond and also show off the diamond. With colored diamonds, one of the best ways to show them off is to have a halo or to just match them with white diamonds around that diamond because it will really bring out the color because you get to see the color next to the really nice white diamond as well. So we don't dislike white diamonds here. We just really love color. And in this type of diamond, you could certainly, again, put a couple halos around it, put it into a ring. We could try our absolute darnest, although it would be very difficult to find a similar brilliant cut and turn those into earrings. So, which we've seen from time to time. We've definitely seen them in yellow diamonds. We had a pair of vivid cushion diamonds a couple years ago, and we sold them to one of Darren's clients, actually, and he bought them for his kids. So
no kidding.
Wow. That was
Wow.
really, I'm not sure if they were twins or not, but that was really great to see a father doing that, and knowing that, I mean, the diamonds obviously have appreciated even since then, comfortably over 15% a year.
One of the interesting things that happened to me this week, I was listening to one of the radio stations, and John Tesh was on, and he was talking about trending. And the thing that we've been talking about for years, in actual fact, is that natural fancy colored diamonds are being purchased, by people right now that are, maybe are in their 40s, early 50s, that second marriages or even marriages that have lasted 25 years, and now are realizing that they want to upgrade on a white diamond. A white diamond there's a lot out there. But when you get into a natural fancy colored diamond, it's something different. It's something to behold. It's something that, the women really go after, and it's something that they want. And they're realizing that they're appreciating in value. White diamonds tend not to appreciate. They're impulse items, whereas a natural fancy colored diamond, whether you buy a yellow, Vivids right now, if you go to our website, Guildhall Diamonds, it's almost impossible to find an internally flawless Vivid diamond. We've got 3 up or 4 up right now. They're a size 162, a 163, and a 175. They are beautiful, beautiful diamonds. But for me right now, the Argyle pinks are the way to go. This is the best investment to get into. Whether you just put it away, put it in a safe deposit box, or even put it into a piece of jewelry, this is going to make you nothing but money. This will make a wonderful, wonderful holiday present, whether it's a Hanukkah present or a Christmas present. This is something that, would go a long, long way.
And we'd like to wish everybody a wonderful holiday season. We hope everybody has a safe and happy and prosperous new year. And we want to thank everybody who has been a client with Guildhall throughout 2014. We look forward to seeing everybody in 2015. And hopefully, with any luck, we'll see a great rise in the prices of silver and gold, and yet again, colored diamonds.
And that number, once again, for the last time this year to start investing, 1-877-8-SILVER. And make sure you go to The Real Money Show and guildhallwealth.com. And while you're there, I want to remind you that for every 100-ounce bar of silver you purchase, you receive one